the ECB had their meeting, and I thought maybe we'd find out that they were preparing to nip NERP in the bud, and NERP, of course, is negative interest rate policy. Doesn't look like it's in the cards. What's your take, Professor?
Well, the Fed had lower for longer. The European Central Bank right now looks like lower forever. They don't really seem to have the tools to get inflation going, to really recover as fully as the United States has.
You know, TLTROs seems to be their favorite tool now, and I understand it. You know, targeted longer-term refinancing operations, and basically they continue to try to keep restocking the banks so they can lend and create transmissions that seem to work. But in the end, these are only half measures. Do you see anything between now and October, when Mario Draghi's term ends, that they could do to try to impede some of the dropping inflation levels that are making them so nervous?
I think it's very tough. I think their tools are very limited. These tools that they're using are basically having the ECB lend to the private sector. And they're reluctant to push that too far because obviously they take some risk at the end of the day. The Federal Reserve did that at the height of the financial crisis, but it's very, leery about doing a lot of that going forward.
Now, I see that the euro currency, albeit it's backed off a bit, but it was targeting around 113. It's now around 112 and 2/3. But I guess my point is, what exactly do you think, Professor, investors were looking at to give rise to the euro currency versus the greenback, considering the bleak outlook of their central bank having no insurance for what may be at some point a recession in Europe?
Well, I think the euro is trading a lot lower than it was a while back, and people are nervous about Europe. Yeah, they don't have obvious tools in fiscal policy because of their various euro-wide agreements. The ECB will definitely act. It will definitely do something, but its tools are very limited. So they just want to do everything possible to stave off a recession. So does the Fed, so does the Bank of Japan. They're all nervous they don't have the tools, but the ECB really doesn't.
All right, the big conversation states obvious. We need to ease. The markets are demanding it. All stimulus is fungible. Isn't it possible that policy, which is just an offshoot of that stimulus, is fungible? Meaning, if Europe and Japan remain super easy, does that take some of the pressure off the demands of the U.S. market to the U.S. central bank?
Well, yes and no. On the one hand, having Europe and Japan grow is very good for us. It increases our exports. It increases demand. On the other hand, if the extent their monetary policy is easier, it pushes up the dollar. And that's not so horrible for us, but it's not good. I think the Fed right now is in a position where they would much rather see inflation overshoot 2% for a sustained period than have a recession. If inflation overshoots, it just builds their credibility that their target's symmetric. They know how to bring inflation down. If there's a recession, they think they have the tools, but they're really not sure.